Right now, TMC, The Metals Company Inc., is trading at exactly $5.51 USD, pushing up by plus 0.090, 1.66% regarding today's intraday movement. Most people look at that green percentage and think they are seeing a standard recovery play, or perhaps a speculative bounce on a penny stock trying to find its footing. That is the expectation, that TMC is just another volatile mining ticker fighting for survival in a world that hates valid resource extraction. But the reality is substantially different, and frankly, much more aggressive. What you are actually watching on the chart today is not just a price tick, it is the market slowly waking up to a geopolitical chess move that the United States government has been quietly orchestrating behind closed doors. While retail traders on Robinhood are flipping this for quick cents, smart money is positioning for a binary event that has nothing to do with rocks and everything to do with national security. We are seeing a decoupling from international bureaucracy and a direct pivot toward American industrial sovereignty. If you think this is just about picking up stones from the ocean floor, you are missing the entire thesis. Let's strip away the noise and look at what is actually happening with the price action this morning. We are seeing sustained buying pressure around the $5.50 level, which has acted as a psychological barrier for the last few sessions. Usually when a stock like TMC hits this kind of resistance, you see a rejection, algorithm-driven selling that pushes it back down to the $5.20s. But today, that rejection isn't happening. Instead, we are seeing a volume shelf building up right here at the highs. This suggests that institutional accumulation is stepping in to absorb the selling pressure from weary retail holders who have been stuck in this name for years. When you look at the Level 2 data, the ask side is getting chewed through much faster than typical average daily volume would suggest. This is often a precursor to a breakout, but unlike the meme stock rallies of the past, this move is backed by a fundamental shift in the company's regulatory strategy that many analysts have not fully priced in yet. Consider the broader sentiment. The general consensus on TMC has always been that it is a wait-and-see story. Investors have been told for years that they need to wait for the International Seabed Authority, the ISA, to finalize the mining code. It has been a narrative of endless bureaucratic delays, environmental pushback, and uncertainty. That is why the stock languished in penny territory for so long. However, the contrarian take, the one that is driving this current momentum, is that the ISA might not matter as much as we thought. The recent pivot by TMC to apply for licenses under U.S. domestic law, effectively bypassing the international gridlock, is the catalyst that changes the math entirely. If the U.S. government creates a domestic pathway for deep-sea mining to secure critical minerals for Tesla stock batteries or Nvidia stock chips, the value of TMC's resource isn't 0 or 5 years away. It becomes immediate strategic collateral. The recent volatility we are seeing is a direct reflection of this tug-of-war between the old narrative of environmental risk and the new narrative of supply chain security. Just look at the volume spikes from the last week. We are seeing days where turnover exceeds 15 million shares, which for a company of this market cap indicates a massive rotation of the shareholder base. The weary hands are leaving, and a new class of investor, one focused on the macro supercycle of commodities, is entering. You see this clearly when you analyze the flow on platforms like Interactive Brokers, where the average trade size for TMC has jumped significantly. It is no longer just the fractional share buyers, it's blocks of 10,000 or 50,000 shares moving at a time. This is the footprint of conviction. Let's talk about the specific intraday setup right now. The stock opened strong, dipped slightly in the first 30 minutes as day traders took profit, and has since reclaimed the VWAP, volume-weighted average price. Holding above VWAP is a classic bullish signal for intraday traders, but for a long-term thesis, it shows that buyers are willing to pay a premium to get in now rather than waiting for a pullback. This urgency is likely tied to the rumors circulating about the Pentagon's increased interest in the sector. We know that the Department of Defense has been funding feasibility studies for domestic processing. Every time a headline drops about China tightening export controls on gallium, germanium, or graphite, TMC stock catches a bid. Why? Because it's the only scalable, non-Chinese source of these battery metals that is ready to go, sitting right there on the ocean floor. It's important to contextualize this against the broader market. While the S&P 500 might be chopping sideways and Apple stock is dealing with its own saturation issues, the materials sector is heating up. Investors are realizing that you can't build a digital economy or a green energy grid without the raw hardware. You can have all the Schwab Intelligent Portfolios algorithms managing your wealth, but if the underlying companies in your portfolio can't get nickel or cobalt because the supply chains are choked, those portfolios will suffer. This realization is driving capital out of overvalued tech software and into undervalued hard assets. TMC is sitting at the intersection of this rotation. It's high beta, sure, but it's also high leverage on the single most important theme of the decade: resource independence. The company itself, for those who might be new to the story, operates on a premise that sounds like science fiction, but is actually simple chemistry. They plan to harvest polymetallic nodules, potato-sized rocks, from the Clarion-Clipperton Zone in the Pacific Ocean. These nodules are rich in nickel, copper, cobalt, and manganese. Unlike land-based mining, which requires digging massive pits, stripping rainforests, and generating millions of tons of toxic tailings, nodule collection is effectively like vacuuming a golf course. The robot drives along the bottom, picks up the rocks, and sends them up a riser pipe to a ship. There is no drilling, no blasting, and significantly less carbon impact. Yet the environmental lobby has painted this as a disaster. This disconnect between the engineering reality and the public perception is exactly where the opportunity lies. The market priced TMC as an environmental pariah, but the data, the actual scientific impact studies, are starting to show that deep-sea mining might actually be the lesser of two evils compared to destroying the Indonesian rainforests for nickel. We have to discuss the financials because this is where the bear case usually lives. Yes, TMC is pre-revenue. Yes, they are burning cash. In their recent reports, they highlighted the cash burn rate, which is a metric you absolutely must watch if you are managing your own Fidelity investments. If they run out of money before they get the permit, the equity goes to zero. That is the risk. But look at the cap table and the backing. They have strategic partners like Allseas and potential interest from major OEMs who are terrified of running out of battery metals. The financing risk is real, but in a world where the U.S. government is handing out billions for battery plants, the likelihood that TMC will be allowed to fail due to a lack of capital is shrinking. The government needs this to work. It's a symmetrical trade. High risk of dilution versus high reward of becoming the ExxonMobil of the battery age. Let's get back to the chart action today, because it tells a story about the psychological state of the market. We are seeing a compression in volatility. The Bollinger Bands are tightening on the daily time frame. Usually, when you see this kind of squeeze after a period of upward drift, it resolves in a violent move. Given the macro tailwinds, the probability leans to the upside, but you have to be careful. If you are trading this on SoFi or another mobile platform, you need to be aware of the bid-ask spread. On days with lower liquidity, that spread can widen, eating into your profits if you are using market orders. Always use limit orders with a stock like this. The market makers know that retail interest is high, and they will widen the spreads to capture that arbitrage. Comment below how many shares of TMC you currently hold, or if you are waiting for a specific price target to enter. I want to see where the sentiment is among the viewers. Now compare TMC's setup to something like Tesla stock. Tesla needs nickel. Elon Musk has pleaded with miners to produce more nickel efficiently. Land-based mines take 10 to 15 years to permit and build. TMC's system is built. The ship is ready. The collector vehicle has been tested. They are waiting on a piece of paper. This is why the U.S. breakaway strategy is so potent. If they can bypass the international 15-year timeline by utilizing the U.S. legal framework, they solve Tesla's problem tomorrow, not in 2035. That is the valuation disconnect. The market is pricing TMC as if it is on the 15-year timeline, but the geopolitical maneuvering suggests they are trying to jump to the 2-year timeline. If they succeed, a $5.50